What's up, guys? It's another Market Radar podcast. We're recording this October 29th. Year-to-date performances so far. We've got the S&P down 18.57%, Nasdaq down 29.99, the big 3-0. Russell, we've got down 18.71%, and the Dow Jones down 10.15%. All of these indexes are still bearish trend. We're not through this yet, despite this rally that we've been having lately. We are still in stagflation. We did have the model indicate a possible chance of inflation. However, the system strength was so low that we did not leave stagflation. But there is something to note about that. Seeing that is a good sign. It's a bit of a light at the end of the tunnel. We might be nearing the end of this stagflation. So get ready, stay ready. We don't know if we're going to be leaving stagflation just yet until the system pivots, but it is a sign showing that the system might be starting to transition out of this stagflation. So it's a really good sign because we're really getting sick of this stagflation.
Yeah, definitely something to look forward to.
Oh, yeah.
Um,
So let's look at the calendar for next week. Monday, we've got Chicago PMI. Tuesday, we've got PMI Manufacturing Final, ISM Manufacturing Index, Construction Spending, and JOLTS. Wednesday, we've got Motor Vehicle Sales, ADP Employment Report, EIA Petroleum Status Report, FOMC announcement, big day Wednesday, followed by the Fed Chair press conference. Thursday, we've got international trade in goods and services, jobless claims, productivity and costs, PMI composite. Oh, sorry, no, that one's not really market moving. Factory orders, ISM services index, EIA natural gas report, and the Fed balance sheet. Friday, we've got employment situation. So, big days this coming week, Wednesday and Thursday. You want to pay attention to those. Wednesday
and
is the FOMC announcement, so be prepared for that.
and Friday as well with the jobs numbers. Don't forget those.
Yes.
Okay. Let's go into a recap of what happened last week. So there's a lot of material to cover. We're gonna go over them quick and swiftly because we want to get into the topic and not sit here and look at historical data. So the manufacturing PMI printed below 50 for the first time since 2020. Something to watch here. That is looking like it's starting to get into contraction territory. Not looking too good for manufacturing. The S&P Global Composite PMI failed to get back above 50, and the contraction readings continue. So again, this has not been able to recover above that 50 level since the end of last year. So excuse me, since earlier this year, once we went below, um, we have not been able to get back above. Services PMI, this as well has failed to get back above 50, uh, indicating that the contraction readings are continuing. We had the United States Case Shiller Home Price Index finally seeing some deeper negative values on an index level, and then also or I should say, declining values on an index level. And slowly, we're starting to see negative values on a month over month and quarter over quarter rate of changes. The year over year, however, is still plus 13%, and this remains extremely elevated, and it's going to take some time for the extreme move in rates to bleed into this index. So we're watching for the year over year figure to come down. Again, interest rates at 7%, mortgage rates, I mean, are not the same as mortgage rates at 2 to 3%. We had the consumer board, consumer confidence still holding under 50. And again, just as the other PMIs, this is signaling a continued contraction. We had US trade balance pulling back under negative 90 billion. But the month over month data is slowly turning positive. So this is something we're watching here. As you know, we've come greatly off the lows, and now we are seemingly treading higher. We have a small pullback. The question is, do we fall apart or does this continue to grind higher? Again, our ROC figures are slowly shifting towards positive territory. We had the United States new home sales. This we're not seeing this fall off a cliff just yet, but the year-over-year figures remain deeply negative at negative 17, almost negative 18%, while the month over month or I should say quarter over quarter and month over month are slowly rebounding. Again, though, we're not really seeing this plunge just yet. We had United States crude oil stock changes shift into the positive. We're slowly starting to see this get back into positive territory. The key is going to be how long and how many the frequency of positive prints to help us or to give us an idea on where oil is going to go. And we had United States durable goods orders month over month still holding positive. So this again, as we saw in 2020, even 2018, 2014, and then as well as in 2008, the GFC, this is still well off of bearish, pointing towards being bearish. This is actually quite bullish in the scope of where we've seen recessions bring this figure historically. On the other hand, though, we had United States durable goods orders, which excluding transportation is known as core durable goods, month over month, go down to the second lowest print of the year. So this is showing a completely different story compared to the headline durable goods. But again, this is still not really falling off a cliff, and it's something to watch as it's not really that bearish just yet. And we had the big GDP come out, I think on Thursday, right? I think this was Thursday. This is plus 260 basis points quarter over quarter, real GDP. We are in positive territory after the last two readings are negative. So this is a big rise out of negative territory. Obviously, um, the deflationists, or I should say, yes, the deflationists, right? The people that are expecting growth to shit the bed are somewhat confused. Obviously, there is some components to this figure that are manipulated, but based off of dollar strength across the imports and exports. But long story short, the figure is positive. Okay. The question now is, does this figure go back down or go back up in the next reading? And we're going to have to wait and see. But realistically, the market will price the move in before it happens. Could it be that we didn't shit the bed and break new lows and fall apart back when ES was here and we had this huge reversal because the market saw the GDP print coming? Most likely, right? Most likely this wasn't able to shit the bed through these June lows for that specific reason.
Mm-hmm.
But we will see how that bodes going forward. We had the United States initial jobless claims come in at putting the year over year figure down negative 22.5%. So, again, extremely tight labor market as to where we were. This is not signaling things are too bad in the labor market as jobless claims have not really picked up. We are still printing relatively around the same values we've been printing since the end of 2021. And remember, for a Fed pivot, most likely we're going to need to see this start to pick up because the Fed's mandate is price stability and maximum employment, and they are under the inception that this is a seesaw. You have to find the balance. So if they see employment at a maximum, inflation on the other end, they're going to try and break one to fix the other, and that's pretty much what we've been seeing, especially coming from the verbiage from the minutes and speeches that Powell has been giving. Let's go to the PCE. This is the one the Fed loves to watch. Higher headline print here, and year over year figures still remaining positive across the board. ROC figures with year over year at 624 basis points, but all are remaining positive across the board. This is something to watch. Again, this is not really signaling that inflation has peaked. Yes, the year over year, we're going to focus on those. At the moment, the year over year figures are going sideways and they aren't really ripping higher as the index prints new highs. So that's somewhat of a start of a good sign, right? And the month over month figures are sitting here on the white line, they are still above positive territory. So the rise in PCE is continuing. Now, we had PCE excluding food and energy. This is what's known as core PCE, come in with a 515 basis point increase year over year. Now, this is actually well off the lows. Unlike headlines, it's going sideways. Core is rising, and this is seen also along in the numbers, in the core CPI numbers. Inflation has left the party of headline figures and is now bleeding into the core markets. And that is not what the Fed wants to see, because that is just proving that inflation remains extremely sticky. And the Fed doesn't want to see people become accustomed to inflation, because what ends up happening is when people become accustomed to inflation, inflation gets inherently worse because it's a self fulfilling prophecy. If you know prices are going to go up, you are going to go out and buy at a higher price because you are afraid of further higher prices. And the only way you fix that is with extremely high prices. You know what they say, that the best cure for high prices is even higher prices. The problem is that we are in a situation where the inflation figures are bleeding into the overall market, yet wage growths are not increasing. So this is what we have known and what we've been seeing as stagflation. And that's the big difference, compared to a regular inflationary environment, or an inflationary regime is where CPI and growth are both accelerating, and that's usually abundant for pretty much all asset classes, outside of maybe bonds and the dollar. Now, when growth falls off a cliff but inflation remains sticky, you fall into what's known as stagflation. And the extremes of where we are, where growth has fallen, now we're seeing a small bounce in GDP numbers, but overall, you can just look at the market as a whole. Growth is in the shitter. It creates such a tail event where bonds and stocks both go down, and we're seeing that happen. We've been seeing that happen for over a year now, and that's something that we have to pay attention going forward, because when there's a pivot, there will be an opportunity to either get long if it's a risk on pivot, risk asset stocks, or if it's a risk off a strong directional risk off pivot, it'll be bonds. We have to sit and wait and find out which one it's going to be. Um, Now we had United States pending home sales month over month. This actually fell off a cliff. So remember, this is pending home sales. These aren't new home sales. They're sliding, and I mean we could have seen this one coming, right? This is the lowest negative print since the COVID crash on a month over month basis, and it is pretty much due to the slowing economy and extremely high interest rates that we have not seen for a very long time, especially on mortgages. And that's where we are here. This is showing you that pending home sales obviously are slowing down. People have to start cutting prices of homes that are on the market, and that is being reflected here with this low print. We had the University, excuse me, of Michigan consumer expectations come in at 52 point, excuse me, 56.2, as above 50. It's okay. We're still off the earlier highs this year, and in the last few years. So consumer expectations have just fallen over the last 2 years as a whole. Then we had the University of Michigan consumer sentiment, again printing 59.8. But while that may seem it's great off the lows of earlier this year, 50, we are still down over the long term. And with that, I think we are going to go right into ES and talk about what happened this week.
Yeah, so another big week, fueling the bear market rally once again. This it may seem small, this rally does seem small compared to the previous bear market rally, but looking at the underlying, it's actually much bigger. We're seeing growth actually catching up, and that's why we saw our system on Thursday start hinting at inflation. Because so right now, let me just, for those that don't know, because there's definitely people listening to this that don't know, our model consists of two things. We have the system, which is our regime model, tells us which regime we're in. Right now, we are in stagflation, which is negative growth, positive inflation. we have two possible outcomes. Inflation goes down while growth remains negative. That's when we get deflation. Negative growth, negative inflation. We get deflation, equities shit the bed, bonds rip. Now we're actually seeing growth picking up. So we're slowly transitioning into a positive growth, positive inflation environment, which is the inflation regime. That's risk on. That's good for equities. And so we're not ruling that out as an outcome. But that's our regime model. We also have DDAP, which is what you're seeing on the screen, the red background. Both need to line up for it to be a confirmatory regime. If we get inflation risk on the system, but ES remains bearish with a red background, we are not going long. That is still risk off. We do not touch anything. So that's just something to keep in mind as you hear us talking and tweeting about growth increasing. If the system does switch from stagflation to inflation, keep that in mind. It's not just a one flick switch. Both need to line up. And
Yep.
that's what we're watching for right now. We're looking to see. It's very possible we get up to Momo. If we go break through Momo and ES turns bullish, shit's gonna get crazy. So get prepared. We are
Yep.
definitely preparing ourselves. We saw this coming back at the lows. That's why we got hedges, and they are paying off. Honestly, just our opinion. We have talked about this. We think this is going to be a bull trap, and probably a pretty massive bull trap, with a continuation to risk off afterwards, and potentially a deflationary pivot. But that's just our opinion, and our opinion doesn't mean shit to the market. That's why we have the system.
Right. And that's the major part. The major benefit of what we do is the checks and balances, folks. Remember, it's not one thing that's going to put us in it's going to send us down a road or to put us in a portfolio positioning direction. It is the balanced decision of two different models that come together and create the final result of the system. And that's really what the important thing to remember is when you're positioning yourself or looking at the market and you're starting to see things move in maybe directions you didn't position for or you didn't believe they could. Just remember the market will do what it wants when it wants. It doesn't care about you. It doesn't care about your financial advisor, and it certainly doesn't care about me. All it cares about is doing what and pricing in what it believes is right. Okay. So as long as you can get that pricing or that model, you have a model that can pick up that pricing efficiently, you will get the market right. And that is where we're going to leave off with ES and we're going to go over to ZN because obviously this week ZN is off the lows. Everyone's talking, I'm seeing a shit ton of people say that inflation is peak. This is it. Time to load up the bonds. I just I can't condone shit like that.
It's just not the. It's just not a good risk to reward ratio. It's
Yeah.
it's really not the play. The Fed is still raising rates. We're not seeing unemployment go up. We're seeing GDP go up. So we're seeing growth increase,
Yeah.
which the Fed specifically said they're going by the data. They're
Yeah.
looking at this data. They're making the decision based on data that's coming out. And right now, the data that's coming out is telling them they need to hike more and harder, which
Yeah,
is
it's
not
not
good for
looking too good.
bonds.
Nope, not looking too good. And just remember this, guys. If the market pivots to inflation, right? We get that risk on pivot we were talking about. ES goes to we get the inflationary system pivot, and then DDAP goes bullish on ES, right? And we're like, oh, good, equities are in a better pricing scenario for higher prices, bullish trends, risk on. That's not good for bonds either. So you have to understand that unless there's a deflation pivot around the corner, it's not looking too hot for bonds.
Yeah. And we're far away from deflation. We're actually, our system is starting to pick up inflation, the inflationary regime.
Right.
which is
Which is
rising growth. We don't even get deflation. If we get rising growth and inflation pulls back, we're still not going to get deflation. Then we're going to
yeah,
be in an expansion.
another risk on regime.
Yeah, another risk on.
Yeah, and
So,
that's something important though that we have to pay attention to, because I think we've made this point very clear over the last few podcasts that bonds can chop here and do nothing.
yeah.
Right? They're not bullish trend yet, and they could sit here for 6 months before they go bullish trend, because remember that the terminals have a really interesting way of doing things. It's kind of funny, right? Bring inflation up to 5%, 500 basis. Excuse me. Bring the federal funds rate up to 500 basis points in like the middle of 2023, but then immediately bring it back down, right?
Hmm.
Like you see the terminal get up to 500 basis points, and it's like it drops. And since this meeting has been since we've been getting closer and closer to the meeting next week, we've actually seen terminals come down, but that's not abnormal. Pretty much every meeting since the Fed started hiking, up until the meeting, everyone was saying that the Fed's going to pivot, bonds would rally, right? And then the market would just get smoked.
Well, now BlackRock analysts came out and said Fed's going to raise 75 basis points, which, I mean, that's a given,
We knew that.
but
That's not
they're going
new.
to have pivot language. Do you expect that?
Do I expect pivot language?
It's funny how
No.
we've gone from the Fed is going to pivot to the Fed is going to have pivot language.
Yeah, that's
they're
funny.
they're
I
just
mean,
slowly these pivot boys are slowly um, kind of just taking what they can get. Like, okay, we won't get a pivot, but we might get pivot language. It is possible. I mean, like the terminals are showing that rates are going to peak mid 2023 and then possibly cut after that. But I mean, that is so far out there. I mean, that's
yeah, I mean,
you're looking at like 8 months out. The Fed funds futures are not accurate to that point, and it's just
right.
not
No,
worth making a bond call position off of that.
this is core PPI, but let me pull up. Hold on. United States core. Let's just pull up the inflation rate core. This is the last print. I was trying to get the index up here, but that's on my other economics tab. It's no big deal. This works fine for demonstration. This is here. Last print, new high. Okay, new high
Hmm.
here. Fed pivot. What pivot?
Yeah,
500 basis points has been priced in for this high, right? And you know what we can do? Let's add something in. Let's go 100 minus ZQ. Let's find what's the month?
we've
April
actually only
ZQ.
seen the inflation situation get worse
Yeah,
this entire time. I think people are just getting used to it. People are getting comfortable with it, so it doesn't
I
seem as
know.
bad. But in reality, it's only gotten worse, and the Fed needs to hike more, and they know that. The Fed knows that.
The terminal rate is derived from the Fed funds futures, but it's all there's a time weighting to it. You can look up how the terminal rates or how expected Fed funds rates are calculated. It's a mathematical formula weighing the days of which the rate is at that rate. It is supposed to be at the target rate, and what days it's at the prior rate. But regardless, we can get an overall view, a somewhat accurate view of where the terminals are being priced, right? Based on just by taking 100 and minusing the month of the Fed funds futures, because the Fed funds futures are quoted in differences against 100. So something at like this would be like a 95, whatever, right? 95.20 would be what the Fed funds futures are, and you minus that from 100, and you get the expected rate, um, the rate at which, again, this is not the rate at which the federal funds rate is going to be, but this is a rate at where um, that's needed to get the federal funds rate to that rate for that month. Again, mathematical. Don't worry about that part. So we have headline CPI here printing new highs, right? And we have the
Hmm.
terminal. We have the terminal following this release, RIP, right? Now the terminal, the reason this is the 5% terminal, not because it says 5% here. This was around the time where the terminal was actually 5%. It happens to so line up with this, and it was in the month of April, which is why we're using the April contract. So we're getting the idea. We're just charting the April contract. Forget about the other months because that was where the terminal really stuck around most of the time, most of this year or last couple of months. So we see the terminal hit 5% and pull back, right? And this here is what people are screaming about a Fed pivot. Realize that.
That's it. That's
That's
all.
it.
That's all it is.
Right. That's it. Excuse me, core CPI just printed 6.6 above the March high.
So, what is the expectation? We're expecting inflation to continue to run hot. Do you expect
Right.
terminals to go higher?
Yeah. I
How
don't think 500 is the ceiling. I don't know
you
where
don't think
how high
so?
it go. No, because we haven't. So look at it from a perspective of just core. Everyone has been talking about headline. We know headline skewed because of food and energy. Let's just look at core. Core is accelerating, right? Um, and it all that needs to happen realistically is the Fed sees another higher core CPI print and the terminal gets lifted. Because remember, the terminal is being priced in, right, into the market at 4 something right now, and the market isn't shitting the bed yet.
Mm-hmm.
So the market is not expecting the market's expecting a 4.5, 4.75, right? 480 basis point terminal, whatever it is right now, and it's not falling apart
Yeah,
just yet.
the market's okay with that.
Right. The question is inflation going to be okay with subduing at that point?
Mm-hmm.
Right? And if we start to see core lift continue to lift, because remember, inflation is a self fulfilling prophecy. If people believe that they have to, like, if you're going to go get an apartment or industrial space right now, right, to rent, the the inflationary numbers in there to hedge themselves out for the next 3 years on a 3-year lease are stupid. Like, they're assuming that inflation is going to stay the same it is right now for the next 3 years. We know it's not, but you have to understand that this is being perceived by market participants because they don't want to take the risk.
Yeah.
So this is the problem. We need to see inflation. The Fed is not done until inflation has peaked. I'm talking rolling over, not this. Oh yeah, like we can put in. You know what? We don't even need to put it in. We know that headline CPI has been chopping at the highs. It hasn't really been ripping, but it's been chopping and slowly going lower, right? Like the problem with that thing is it's not falling apart. We
Mm.
need headline CPI well in the mid sevens, under sevens.
Yeah.
Like
Everyone's
what's
trying to
going
front run that though.
I know, but like okay, yes, the base effects, that's gonna happen naturally. I understand. But why are you thinking logically with illogical thinkers?
Yeah.
Right? We're using common sense with folks that don't use common sense. The Federal Reserve, you know, you got Biden coming on TV saying that from what I saw, it was some recording, and when he took office, he said that gas was at $5 a gallon. He brought it down to 3, right?
Mm-hmm.
Um, while that's ridiculous, that's not even the scope of what I'm saying. The scope of what I'm saying is that he is hammering gas prices because that is what everyone's looking at. Inflation. Inflation fucks everyone. Corporations, consumers, and even the government, right? So if that does not get evade and all eyes are on the Federal Reserve right now, right? They're getting all the scopes on their heads. They better fix this. It's their job. So are they going to give the market the opportunity for another 1970s event?
No, definitely not. They
Right.
specifically said that that's what they've been looking at and they do not want to repeat that mistake.
Right. So we can infer that okay, if let's just look at it this way. Commodities haven't fallen really to their, we have not the cure for inflation is deflation.
Yeah.
That's it.
Yeah.
We have not seen deflation yet.
No.
Yields are still up, right? I mean, let's look at
Growth is
yeah.
rising again.
Let's just look at the US 10-year on a new price scale. Look at it. What's deflationary about that? We'll take off the headline CPI. What's deflation about this?
Yeah, there's absolutely nothing. But everyone's just trying to front run it. Every little piece of data that comes out that might be deflationary, just a little hint, everyone takes it and runs with it and says
Right.
inflation has peaked because of that.
Now I want to also make this point. It's important. There's I am going so my mentality is not I'm going to cherry pick my peaks. I'm not a bottom or a bottom picker or a top picker. Like that's, we don't catch falling knives. We don't guess we don't guess anything. We just take what the system and what the environment is telling us. So at some point I am going to be wrong with saying that terminals are going to continue to rise because they're not going to rise forever, right? That's going to happen. But the question is, in the right or wrong scenario, I will realize I am wrong when I get a deflationary pivot before it's too late to make money,
Mm-hmm. Yeah.
right? Like if I say terminals aren't gonna go up, or play this example. I'm going to say terminals are going to continue higher above 500 basis points above. Now we get to 525, above 50, 550, 575, right? And eventually they fall off a cliff, right? We get some type of rate cutting cycle. And we're going to go over the flattening and steepening of the yield curve in a few minutes here to sum up what that looks like. But long story short, yields fall off a cliff, right? Terminals fall off with them because the Fed's cutting. What happens? Well, the only downside to that of me calling for higher and higher terminals is if that whole event unwinds and I don't get to take part in it, right? Because if I get to catch the way down, it only makes sense to continue to cheer for higher terminals because that is what the market's pricing in. If I sit here and say, "Oh, terminals are peaking," I'm fighting the Fed, I'm fighting the market, I'm fighting my system. I'm just talking out of my ass,
Mm-hmm.
right?
Yeah.
But if I'm sitting here and saying terminals are going to go higher, and the famous saying or the saying that I say all the time, it's bullish trend until it isn't, and it's bearish trend until it isn't. If it's bullish trend, it's bullish trend until it isn't. I'm not gonna sit here and tell you, oh yeah, I already have the trend and system models made, fine tuned and perfected. What am I gonna sit here and tell you I can time tops and bottoms? Because obviously, if I could do that, I wouldn't be talking to you.
Yeah. It's not about timing tops and bottoms.
Yeah,
The top can happen and there is still so much money to be made.
that's my point. If I could time tops and bottoms, I
Yeah,
I
if you
would
could
be
time
I
tops
would
and
be
bottoms, we would
yeah
be buying 1 week till expiry
yeah
options, just
yeah. I wouldn't
making
even. I'd be
tens of
done.
thousands of percents every
I
time.
would be done. I would do it for a year, and I'd make enough money. I'd fuck off for the rest of my life.
Yeah,
You know,
yeah.
my goal is 100 million.
That's
My
not
goal
the
is a
game we
hundred million
play.
dollars. Yeah, my goal is $100 million. If you could time tops and bottoms, you can make that in. You can make that in fucking 6 months. Do it right,
Yeah,
right? So if if that's the case, that we understand that trends continue until they don't. Well, guess what else is bullish trend if you think about it? CPI, right? Because
yeah,
CPI is reflected within bond yields. So if bond yields are bullish trend, and we'll take a quick look at bond yields right now before we get into the flattening and steepening of the yield curve. So let's look at US. Let's just look at the 10-year. That's the one everyone loves, right? Put on DDAP. Look at this bullish trend. So I'm going to show you something. This is FinTwit. This is every guy that wants to be a macro trader. Every guy that has some type of ETF or product that they're selling you to raise money. Anyone that is basically a quote unquote advisor in the space that manages money is trying to fight this trend because their models are broken and nothing is working. So if they can get a peak here, at least something will be working, and it's likely people are expecting that we are going to see a peak here before we see a bottom in stocks. Because remember, if this goes deflation and shits the bed, well, stocks will go down too, but at least bonds will be working. So that's where people are.
hmm
So why people are so adamantly talking about this. But let's look, right? This is why FinTwit gets this wrong. If I were to take this off, this DDAP trend, and you just look, and this is the power of DDAP too, right? Because without this, you're looking at this, and you can put some moving averages on here, but you don't really get the full scope of what we're about to show you. Any move up, right, and any move down thereafter, you're inclined to say rates have peaked, right?
Yeah, yeah, it's
Just like when rates have fallen, right? Look at this. Let's go back. Forget this 2020 event, right? Look at 2019. Rates are chugging higher, right? Well, I mean, look, rates are bottoming. Rates have bottomed. Roll over in bonds. Rates are done. And then this, right? So here again, look at this. Rates are down, right? Remember this in July of this year, rates were
mhm.
down. Oh God. Oh God. People were like, oh, this is the peak. We had many people say dollar top, all this bullshit, right? And then this, and everyone was getting all confirmed, juiced up, bulled up on the bonds, everything, right? And this was right into like I think a Fed meeting, and look at that, and look at that, and now we're
Yeah.
here, right? So it's like you've gotten roped along. I can sit here and try and play the game where I go, let's take a circle, where I go like this. Take this off. Sorry, guys. Stupid trading view. Okay, let's go here. Right, look at this right here, and let's go here. All these peaks, right? All these times, 10 years peaked. Who was here to tell you that this race would go higher? We were, right? And what was everyone else telling you? Rates have peaked. Well, that's because they don't understand what the situation is. The reason I can tell you that the odds of rates peaking here, here, and here is because the trend remained bullish the entire time,
Yeah, it
right?
never changed. Nothing
Right.
materially ever changed.
Right. So if I see rates are here, right? And you know what? We'll bring in the dollar in this one, right? This is an important one. Dollars here, right? So dollar highs, everyone say, oh, peaking dollars in. How could I believe that? What has changed from here to here? Right? All these times, peak dollar. I mean, let's go to our friend. Where's our friend? Here he is. He, this guy was telling you peak dollar here. Dollar peak because of this. And look at this rollover.
Yeah, at the end of the day, it's a lot of it is just common sense.
Right. Like you just have to know that, but it's bullish. Listen, it's really stupid. I know, but it's the simplicity that makes it work. It is bullish until it's not bullish. Your macro thesis aside, your reasoning for whatever, the thing is bullish and it's going to stay bullish until it's not bullish. And when it's not bullish, then we could talk about dollar peak. But
Yeah,
to sit here and claim dollar peak this whole entire way, what are you're gonna sit here and play this game where you're gonna be able to time? You're gonna be the guy that says dollar peak and you're gonna catch the top and you're gonna nail it and you're gonna nail the bottom too. Like it's unrealistic. So just go with the flow. The trend says dollar up. The 150, the 114, 115 highs in the dollar are probably not the peak unless the trend changes. Then I'll tell you that the dollar peaked.
yeah,
But I've been right this year every single time by doing that. So think about the amount of times I've been wrong with that. Think about this dollar bottom, right? Dollar bottom, dollar bottom, dollar bottom, dollar bottom. Meanwhile, I come in here and I say dollar bottom. But look what I did. I got the dollar from here to here. Dollar bottom, right? Dollar bottom. Think about all the people that said dollar bottom here, right? A bunch of people that were saying, "Oh, dollar's going to squeeze, dollar's going to squeeze, dollar's going to squeeze." Yeah, okay. But again, bearish trend, right? Like it's
yeah.
bearish
Just
until it's
don't
not.
fight the trend.
Don't
Don't
fight the
fight the
trend.
Fed. Don't fight the
Don't
trend.
fight the trend. Pretty much. And with that, I want to segue into the twos and tens and the effective federal funds rate. So there's a lot of people looking, trying to figure out how they can play the steepening of the yield curve. The yield curve has flattened dramatically in the last year or so, right? We were up from 140 basis point spread on the twos and tens all the way down to negative 40 basis points. And the key to this is what the Fed is going to do. Because so it's usually the Fed hiking that compresses the yield curve and the Fed cutting that steepens the yield curve. So it's Fed, think of Fed height and flat, Fed hiking, flattening, Fed cutting, steepening. It's when the Fed starts cutting that the yield curve can expand because the whole reason the yield curve is inverted is short-term treasuries are above that of longer-term yield. So let's take a long In the scope of 10 years, the odds of inflation being an extreme issue are much lower than the next 2 years, which is why you're seeing the yield curve invert. Okay, people are pricing in more inflation short term than long term. That's the yield curve inversion, right? Yields are higher short term than they are long term. Well, when that's over, the Fed's going to cut rates. Well, the short end of the curve is going to fall drastically, and we'll be back under the longer end of the curve, and the yield curve will be more uh, positively sloped and flat, right? And
Hmm.
when that's happening because the Federal Reserve is bringing down their effective federal funds rate. And the question we should be asking here is not is the yield curve going to steepen, or when is the yield curve going to steepen? Because we know the Fed is not going to cut anytime soon, right? We're expected to hike all the way into the middle of next year.
Yeah, so we're expecting the yield curve to invert and flatten even more
Right.
until
Well,
the Fed changes.
yeah, to stay inverted until the Fed changes. Yes, and there's some big risk here now. And I'm gonna the big risk here is I want to explain is if we're talking the twos and tens curve, right? The way you calculate that obviously is by taking the 10 minus 2. The Federal Reserve is going to, the longer the yield curve remains inverted, the more shitty the outcome is going to be, right? Because the longer that you can get higher yields short term, the less the worse the environment's going to get. Usually, yield curve. Think about it. Look in 2008. If we go back to 2008, the yield curve inverted. We'll do some quick calculations, right? The yield curve inverted. 2006, that was like the first inversion. So we'll say we flirted with inversions from 2005 to 2 years, right? So we've been flirting with inversions for 6 months now. What happens if this goes on for another year? Like the steepening curve would be epic, by the way, because the Federal Reserve would be cutting short ends and people would be chasing bonds because they've been dead for so long. But on top of that, what's happening? What is going on to create this environment of negative? Like, why are we having this negative yielding environment? Why is the Fed pushing the yield curve up on the front end? Well, the front end's getting pushed up due to rate hikes. It's because inflation has not been controlled. If the bond market on a 2-year basis thought inflation was remotely controllable in the 2 years, this would start steepening. The
Well,
bond market,
also, if the bond market thought inflation was getting under control, longer maturity bonds would not be going up. But we have been
right,
seeing them going up. It's bleeding into the entire curve.
right, and that's an issue. That's an issue, right? Especially like tens, right? Tens remain super high. They're not super high, but look, the terminal rate's like 400. Right? It was about 500 in the last 2 weeks, right? 10 years not obviously there, but 10 years showing that there's a significant risk that inflation does remain sticky. And the twos and tens are good. Again, yield curve, um, yield spreads, right? This is the twos and tens spread, part of the yield curve, are great indicators of what is going to happen next, right? It's the yield curve inversions that are reversions that are the lethal part, not the inversions.
Mm-hmm.
Because for the yield curve to revert, the Fed has to cut, which means we're in a recession,
Yeah, the Fed
right?
the Fed is cutting because shit is hitting the fan and they need to stimulate the market again.
Right. And that's where the reversion happens, right? Because look here, right? The curve, the spread, I mean, really picks up when the Fed starts cutting. Same thing here, sideways, sideways, and this thing starts ripping. And we don't have a longer dated one in this trading view because I'm looking for there is another data series, but it doesn't show well, so I'm using this one. But you get the point. Um, the EFFR falls with the spreads rip. Same thing here. When the spreads rip, the EFFR is ripping, inverse, right? Now here the spreads kind of came off their highs and moved lower in anticipation of this. The market was kind of picking up on this, right? Like the market started falling apart before the Fed even was hiking. And then we had the inversion here. The Fed immediately cut their rates, saved the inversion, right? And now we're back to the same point that we need a Fed cutting cycle to get the bond steepening trades on the table.
Yeah.
I should say the steepening trades. The flattening trades. I don't see there's any point in playing anymore, right? Because we're already flattened to negative 40 basis
Yeah, we're
points.
not really gonna get much flatter or much more inverted than where we are right now.
Yeah, I mean
I mean, we're
it's
like the
pretty
most
bad.
inverted we've been since, I believe, 2000. I don't
Yes, we
think
are.
2008 even became this inverted.
No, it didn't.
Yeah.
So this is going to be very interesting. Now, I want to finish this podcast off with some quick talk on the on what's been going on here with these bonds, especially 30-year yields. Let's put this
So we're
on.
seeing 30-year yields rising just as we've predicted. They need to be higher than the inflation rate for
Yes,
inflation to come down. And we're seeing that
yes,
happen right now. We're seeing them converge with the 30-year coming up, and they might meet in the middle, probably at like
yes.
5%.
Let's put inflation on the um year. Oh, okay. And let's see. Let's see if we can. hmm, So the 30-year is going to is going to dominate this. What we've been saying, right? The 30-year is going to get above. Let's make this white so we can see the difference. The 30-year is going to get or likes to stay above the overall CPI number as a whole. Okay, and as you see the 30-year fall, so is CPI, where it's been going lower, and we have this huge move here, this epic move where CPI is well above 30s, and 30s are ripping. The convergence is going to happen over here. But the bigger issue with with longer end bonds at the moment is like let's add real yields onto here, is the real yield situation. Okay. And I'm going to remove some stuff here. I'm actually going to just go right to real yields because I think that's where we end this off and um and talk about this because this is an issue. Okay. Everyone's looking at the bond trade, right? You want a long bonds? Okay, well, and you want a long gold, you're gonna need a peak in real yields. You're gonna need a peak in real yields to happen. This is where real yields are right now. Okay. And we'll just draw a zero line in here just to get some perspective. Wait. Okay. Real yields are here. So we're well, especially on the longer on 30-year, we're well positive. Tens look a little different, but just follow me here. You'll get what I'm trying to say. If we have any type of financial crisis, right, with any of these banks where they need to sell United States bonds, longer term bonds, right? You're going to see gold get smoked too, most likely. Because if you start unloading treasuries on the long end, not because of inflationary reasons, but because you need liquidity and you fucked yourself with your own currency issues, right? If you understand how real yields are calculated, they're calculated between the nominal and the break even. And tips only make up a small portion of the market, so it's not like people are unloading tips. You're unloading the bonds, which are the nominal yield. So what you're doing is you're pushing up nominals, but break evens aren't moving because the issue with inflation isn't really a factor here. It's another country's liquidity problems, not the effects of inflation, right? So if break evens stay where they are, and let's look up T30-year IE, right? We can look at the break even rate. This is the break even rate. Okay. If break even stay at two, and let's add in the US 30 on top so you can understand what I'm saying. Move this over to the right. So here we're gonna bring this white. So here, this is the spread on real yields, right? It's the difference between the nominal and the break even. Well, if say BOJ starts unloading treasuries, right? What's going to happen here? This is going to rise. This is going to rise,
The
and
30 year is going to rise.
well, the 30-year yeah, because they're selling bonds, right, to raise dollars, right?
Hmm.
So bonds are flooding the market, so rates are going to go up. Okay, and I'm sure that look, it's not going to just be 30 years. They have more. They have different holdings across. They have holdings across the maturities, but they, I'm from my understanding, I believe most of their holdings are more shorter term. Okay, But you get the point. If people start selling 30s and they start picking up, and this is just not, I'm using longer term because what ends up happening is you're going to affect mortgage rates, everything, right? Because you're going to want to, you're affecting nominals on nominals affect everything from mortgage rates, all these like longer term financing. So nominals go up. Okay. But is that really like what's going on with inflation, the break even, the expected inflation over 30 years? It's not going anywhere, right? Because you don't have a market moving event that's moving this on based on inflation. You have it on a liquidity issue. So nominals will just skyrocket while break evens might just go sideways. Real yields are going to explode if that were to happen, if this scenario were to come true.
Yep.
And gold will get crushed because gold, we know gold's correlation to real yields, right? Gold real yields up, gold going to go down.
Yep.
Bonds will go down, right? So if you're buying bonds or you're long bonds and you believe there's going to be a big debt crisis coming, you have to understand that the real yields rising will hurt you if that is to happen.
Will
Same
hurt
thing
you
with
as in
gold,
what? If you're long gold?
gold or bonds,
Yeah.
right?
Okay.
Like if you're long bonds for a recession, but you think the BOJ is fucked and has to unload, think about that for a second, right? What are you doing?
And that's a likely outcome from the way
Right.
things have been going.
Yeah, I mean the way that they're playing their cards, it's pretty bad. Um,
But yeah, I think we could end it off there on
yeah,
a
I think that's a
sad
good place.
note,
Yep, yep,
on a
it's a good place
massive
to end it off.
liquidity issue, which
But
is
it's been
likely.
brewing. It's been brewing. We've been talking about it. If it does, it may not ever happen, but if it does, just remember the concept on real yields and gold. Okay, that's all we need to worry about. Other than that, I thank you guys again for spending your time listening to our podcast. If you enjoy this podcast, please like and share and subscribe. Our website, where you can get more information on what we offer, is www.market-radar.com. We have a free Discord and we have a Twitter as well at the Market Radar. We hope to see you guys next week.